Costing. Standard costing is basically a costing method which is used to measure the standards in a particular environments. And based on the principles of standard costing, we use to calculate the variances. So in this lecture, this is the first lecture, we will discuss all the basic concepts related to standard costing and variance analysis. Before moving to standard costing, first of all, we all must know that what is a standard. A standard is basically a benchmark of a measured resources. For example, if you are producing a product and that product requires the materials, and the materials are, let's say, 3 kgs are required to complete 1 unit of a finished product. So a standard is the measurement of resources, and the resources could be material, labor. Let's say 5 hours are needed to complete 1 unit of a finished product. Then there might be the variable overheads incurred on that product, there might be the fixed overheads incurred to complete that product. So basically, if we look at the notes, a standard is a benchmark measurement of resource usage set in a defined condition. So what is the concept of defined conditions? Let's say we are manufacturing a shirt, and you all know that manufacturing of the shirt is depending on the size, either small size, large size, extra large size. So depending upon the size, there is a larger consumption of cloth. So all the resources measured, for example 3 kg, 5 hours, so these are measured under a certain set defined conditions. A standard cost, now we are moving to standard cost. The first thing I told you was the standard. A standard is a predetermined per unit quantity set at a standard benchmark. And the standard cost is the cost based on standard quantities. For example, when we said that this product will be using 3 kgs of raw material, and what will be the rate of that raw material? Let's say that is $10 per kg. So if this is the rate $10 per kg, it means that there will be the cost of raw material used for this product will be $30. And if the labor required is 5 hours and we are paying to the labor at a rate of 8 per hour, it means $40 will be for the labor cost. And similarly, if the overheads are absorbed on the basis of labor hours, then the per unit time will be 5 hours. And for fixed overheads, it will be again for 5 hours for one single unit. I assume that this is absorbed on the basis of labor hours. This would be the machine hours as well, or even some cases, as we have studied in the absorption of overheads, that there are 6 bases. Practically, we can use any of these bases. But here, I am assuming that the overheads, both variable and the fixed, are absorbed on the basis of labor hours. And what is the rate of absorption? Here, in this question of variances, you are not required to calculate overhead absorption rate, because examiner has tested you the OAR calculation in the chapter of overheads. So in the calculation of variances or the standard cost, there is no need to calculate the OAR. But in some exam questions, you can be required to calculate the OAR as well, because OAR calculation is not too much complex. You all know that OAR is calculated by dividing budgeted overhead cost with the budgeted base. So what is the variable overhead absorption rate? I am assuming that this is 3 per hour. It means the variable overhead cost will be 15. And I assume that the fixed overheads are absorbed at a 5 per hour. It means $25 will be the overhead cost. And now, what is the total production cost? What will be the total? Is that
110.
So 110 is the production cost. And there is some other non-production cost, might be the selling element. I assume that this is 20. So the total cost will be $130. And let's say there is a gross profit. I assume that the profit is to be charged at 20. So what will be the same price? 150. And this is whole document is known as standard cost card. We name it as standard cost card. So what is a standard cost card? A document which shows the calculation of per unit cost for a certain product. For each type of a product, we are having the one separate standard cost card. What are the written in this document? The per unit quantities, the standard rate, and the total cost per unit for each type of a resource defined at a certain condition. So there will be the $30 for materials, 40 for labor, variable overheads are 15, fixed overheads are this one, total production cost will be 110, and the non-production cost will be $20, total cost will be 30, and I am assuming that there is a profit margin or markup of $20 and the price will be 150. So this is a standard. We have set for a certain product in advance. But practically when we are going to produce this product, there might be the different resources consumed. Let's say actual production was 1200 units in a period. That period might be a month, a quarter, a year. And actual material cost, actual labor cost, variable overheads, and fixed overheads. Let's say the actual material cost incurred was 40,000, and this 40,000 was for 3,500 kgs. So actual consumption was 3,500 kgs, and actual cost was 40,000. And similarly, there might be the labor hours 6,500 hours. Actually, we have worked for, and the cost paid is 50,000. So this is the cost paid to the workers. And similarly, we can assume something like 12,000 for variable overheads and 30,000 for fixed overheads. So this is the actual cost. But now we need to calculate the variances. We need to calculate all possible variances from this data. Before moving to the calculation of variances, let me tell you what is a variance. What is a variance? Variance is the difference between planned or budgeted data and actual results. So variance is the difference between planned or budgeted data and the actual results. So whenever there is a difference between these two, this will be known as a variance. A variance could be either favorable or adverse. So this is the terminology to be used for variances, either favorable or adverse. A favorable situation will be a situation in which we are having more cash than expected. I write it is a situation. Favorable situation is a situation where we are having more cash than expected. So that situation will be a favorable situation. When we are having a more cash, the situation could be the lower of the cost. For example, we have assumed that we will be buying the material at a rate of $10 per kg. Favorable situation is when we are having more cash than expectation. I was telling you that we have assumed that we will be buying the raw materials at a rate of $10 per kg. And at which rate we have bought this material? If I calculate the rate, $40,000 divided by 3,500 kgs. So what will be the per kg rate? 11.43 per kg. So this is the rate. There is a difference between the standard rate and the actual rate. This rate is known as standard rate. This rate will be known as standard rate. The rate as per the standard conditions and the standard quantity. And actual rate is the rate of actual consumption or purchases based on actual data. So this is the actual rate. So there is a difference, and this difference will be known as a variance. So if we are paying more, it means we are having less cash. If I am paying more, instead of 10 I am paying 11.43 per kg. So as a result of this extra payment, my company, my organization will be having a lesser cash, a fewer cash. So in this case, this will be an adverse variance. But let's say if we buy this material at $9 per kg, then I will be having a saving of $1. So as a result of this saving, my company will be having more cash. Is it clear? So this statement must be clear to all of you that favorable situation is a situation where we are having more cash than expectations. And adverse is the reverse of this, when we are having less cash than expectation. So that situation will be an adverse situation. And similarly, let's say, look at the board. If we are selling it at $150 per unit and we actually sell it at $170. So in this situation, I will be receiving $20 more as a revenue. So when I will be receiving $20 more, this will be a favorable situation. So don't cram it that whenever we are having a lesser figure, that is a favorable situation. No, it all depends on the situation. For example, for the cost, when the cost is lower than the expected cost, then this is a favorable situation. Whereas in case of the revenue, when the revenue exceeds the expected revenue, that is a favorable situation. So I hope that you all people are getting what I am saying. The variance can be of two types, favorable variance or adverse variance. So adverse variance is a situation when we are having less cash than expected. In some books, adverse variance is also named as unfavorable. So both are interchangeable terms. You can use the word adverse or unfavorable. It's the same thing. But there is only one word, that is the favorable. There is no alternate word available for the favorable variance. Normally in questions, we show the favorable variance as F. This is favorable variance, and for adverse we will use A. And if we want to use unfavorable, we can use the UF, unfavorable. But in 90% cases we use F and A for adverse, F for favorable. So the question was saying that calculate all possible variances. Remember that. We can only calculate the variances for those items for which we have set a standard and we have the actual data. Because as per the definition, the variance is the difference between standard and the actual results. So if we are having standard and the actual, we can only calculate the variance in this situation. For example, in this question, I have no data for the non-production cost in terms of actual data so far. So I cannot calculate the variance for non-production cost. But if I want to calculate the variance for non-production cost, I must have the non-production cost data in actual terms. Then I can calculate. Now, if you look at this standard cost card, I told you that this will be showing the per unit data. But here we have used the word budgeted. So what is the difference between standard and a budget? Remember that standard is always a per unit calculation. But when we plan for the per unit calculation, we always plan for a budgeted level of activity. For example, we will be producing as per these instructions for a budgeted level of 1000 units. For a budgeted level of 1000 units in a period. So this is our planned level. Budgeted means planned, just like in the chapter of overheads, you have studied that. There is a budgeted level, budgeted production units, budgeted labor hours, budgeted machine hours. So this is the budgeted production. So if we multiply 30 into 1000, so this will be the budgeted material cost. And if we multiply the labor per unit cost with the budgeted level, this will be the budgeted labor cost. Now, how to calculate variance? The next thing is how to calculate a variance. In order to calculate a variance, we must compare the figures like with like. We must compare the figures like with like. For example, let's have a look on the calculation of the material variances. That how we will be calculating a material variance. If we look at the data, we have set a standard that we will be using this quantity for one product, and this will be the rate for 1 kg. Is it clear? And what we have actually done, we have produced 1200 units, we have consumed 3500 kgs, and we have paid 40,000 for the raw materials. Now I am going to tell you that how to calculate the variance for materials. There are two standards. One is related to usage. This is related to usage. And this is related to rates, cost. So there will be two variances for the raw materials. Material variances. I told you that there are two possible variances depending upon this data. One is the material usage variance. Material usage variance. As the name suggests that, this is the variance of the usage. How much we have consumed as compared to standard consumption. If we look at the data, we are required to consume 3 kgs for one single unit. And we have produced 1200 units. So as per standard instructions, how many kgs must be used? 3 into 1200. It means 3600 kgs should be used for this. And how much we have used? 3500 kgs. It means we are using 100 kgs less than the expected consumption. And if we are using lesser quantity, what does it show? That we are saving the cost. And if we are saving the cost, this is a favorable variance. Is it clear? The concept is the difference between the standard usage and the actual consumption or the actual usage. So in order to calculate the material usage variance, the formula will be standard quantity for actual output minus actual quantity used. So as per standard, I was given an allowance to use 3 kgs and actual output is 1200. So I was allowed to use 3600 kgs and I have used 3500 kgs. It means I have used a lesser quantity. And there is 100 kgs saving. This is a favorable situation. Remember that the variance is always in dollars. The variance must be in dollars so that we can compare how many dollars we have saved or how many dollars we have spent more than the budget. So in order to convert this kgs into dollar, there is a standard rate in the formula. So this answer will be multiplied by the standard rate, and the standard rate is $10 per kg. So if this will be multiplied by $10 per kg, so this kg will be cancelled out because due to per kg, per mean divided. So when we will multiply, it will show that we have saved $1,000 in terms of the consumption of the raw material. So in terms of the consumption of the raw materials, we have used $1,000. Clear? Now, we will be looking at the other variance, and that variance is the material rate variance. That variance is the material rate variance. Please be attentive. As the name suggests, that rate variance is the variance of rates, just like in the previous question. The usage variance was the variance of usage, standard usage and the actual usage. So there is a difference as per this definition, the difference between planned and actual results. So in order to calculate a variance, we must have a standard data and the actual data of the same thing. If this is a usage, there was standard usage and actual usage. Now the formula is showing that we are going to calculate the rate. So there will be two rates in the parentheses. One is the standard rate and other one is the actual rate. So there is a rate variance, the difference between the standard rate and the actual rate. And this rate will be per kg. So first of all, this is the $10 as per the standard cost card. The standard rate of this type of raw material is $10 per kg. And if we look at the actual data, we have paid for 11.43 per kg. So we are paying more, $1.43 per kg. We are paying 1.43 extra. So this is the adverse situation. Now this is the variance per kg. After 1 kilo, how many we are paying in extra or how many dollars we are saving. So here in this situation, as we are paying more, it means we are paying extra cash. So this is the adverse situation, but this is per kg. Now in order to convert this variance into totality, we will multiply this with the actual quantity purchased. That how many units we have purchased in this period for which we are going to calculate the variance. So we have purchased how many kgs? So this is the actual data. From actual data, we will be able to get the figure of actual purchases. This is 3,500. So what will be the final answer? 3,500. 5,500 dollar. 500. So I guess that if we may take it the full figure, this will be approximately 5,000. You can take it the full figure as well, in order to avoid the rounding calculation. Is it clear? So this is the adverse variance. And if I look at the total, that what is the total variance? Because we have named that the material variance is can be of two types. One is the usage variance, other one is the rate variance. And now, if I make it a total material variance. So total of the material variance will be the sum of these two. I repeat, the sum of these two will be known as the total raw material variance. So one is the 1000 favorable and other one is the 5005 adverse. So if we add it, it will be 4005 adverse. How? Because one is favorable, one is adverse, just like the positive and negative sign. So as the signs are opposite, they will be in fact subtracted. They will be subtracted. But if the signs will be the same, both will be favorable, then it will be added. If both will be adverse, then it will be added. But one thing is favorable and one thing is adverse. When we will add it, practically we are subtracting it due to the opposite sign. Because one is in the favorable situation and the second variance is in the adverse situation. So in that case, there is a net effect of 4005 adverse. Why adverse? Because adverse figure is greater than the favorable situation. So adverse will prevail. Just like if the negative figure is higher, the answer will be in negative. Is it clear? Now, if we want to reconcile whether this calculation is correct or not, so we have another alternative way to calculate total material variance. So there is an alternate. If we look at the data, we are saying that we will be producing a unit in $30. We are producing a single unit in $30. How this 30 comes? 3 into 10. So there is the standard cost 30 for actual output. If I want to convert this 30 in totality, that what will be the standard cost for actual output? Into 1200, because the actual production was 1200. So what will be this? 36,000. And what is the actual cost? Because as per this definition, the variance is the difference between standard cost and the actual cost. So standard cost is 36,000. It shows that I must spend $36,000 to produce 1200 units of a product. But in actual, I spent $40,000 for the raw materials. I spent how much? 40,000. And if I look at, there is a variance. So variance is 4,000 and I am subtracting a bigger figure from the smaller figure, so the answer will be in negative. And as per the concepts, this is an adverse variance. This is an adverse variance. So this is calculated in totality because I have taken 30. I have not taken 3 or 10. I have just taken the total answer of raw material. So this is the totality by multiplying the rate and the usage. So there is the total cost as per standard is 36,000, but actually my company had paid $40,000 for these raw materials to produce 1200 units, which shows that there is an adverse variance, and this 4,000 is telling with this 4,000. This 5 is due to rounding. If you are taking the whole figure, it will be exactly matching. Is it clear? So in this way, we can reconcile that our calculation is 100% correct. Now, what is the interpretation of this variance? What is the usage of this variance? We have seen that this company has paid 4,000 extra. And if we look at the reason that why this 4,000 is extra, we are having two options, two investigations, that the usage was favorable, but the rate was adverse. And ultimately, the net effect is adverse. Now, if the usage is favorable, what can be the reason of this favorable? And if this is adverse, what can be the possible reasons of this adverse variance? And if this is adverse variance, then what are the reasons of this adverse variance? There can be any type of the reasons. For example, when we have planned that the rate will be 10 per kg, and this was done a year ago. So during the year, due to inflation, this rate might not be the actual rate. But here in this topic, we are assuming that there is no inflations for the time being. But in practically, we can have a situation when the rates can be affected due to inflation. Just like in the countries like where there are no stable economies, so the rates are changing on daily basis. And sometimes, if we are buying something at an extra rate, we probably have that product in a good quality. If we buy a product with extra money we are going to pay, it is possible that we are getting a better grade quality. For example, that 10 is, let's say, for the A grade raw material. And now I have bought it 11.43, but this is A plus grade material. So if we are buying a better quality, obviously the rate will be the higher. And if we are buying the better quality raw material, the rate will be the higher. But as a result of this good grade of buying of the raw material, the usage will be favorable. And this is even can be assessed from this data, that there is a chance that we have bought a higher quality raw material. As a result of this higher quality of the raw material purchased, we are having an adverse price variance. But this good quality material is consumed in a lesser way, so we are having favorable usage variance, because we know that the cheaper things are used more and the good quality things are used less in quantity. So ultimately we are able to investigate the two portions. One is the usage, and the usage is the responsibility of production manager. If there is a favorable usage, then all credit might go to the production manager as well. And if this is an adverse variance, and the same will go to the production manager. But here, as I told you, that there might be a chance that we have purchased a good quality of the raw material, and as a result of this good quality of purchasing, we are having a favorable usage. So in this case, there is an interrelationship between the variance, that this usage might be due to this decision. There is no harm to give this credit to the purchasing manager for this favorable usage as well, because he decided wisely. He bought a good quality of the raw material. Ultimately, he paid for the more cash, and as a result of this quality buying, the company is having the favorable usage variance. Is it clear? So in the coming few minutes, we will be discussing the reasons, the interrelationship between the variances. So if there is any question, you may ask. Pause.